So we had a big crash in software stocks on Thursday, with Salesforce reporting worse than expected results. Salesforce down over 20% on that day, and then that dragged down ServiceNow, and then Veeva reported results as well, went down over 10%. Microsoft went down as well. Adobe went down as well. So is this an opportunity to buy these software companies, or should we sell and get out? Well, let's find out in this video. So all hell broke loose on Thursday in the software industry space, with Salesforce reporting results worse than expected. So they actually missed on revenue by 1%, but they beat on their earnings. But they lowered their forward guidance by 1% as well, but the market freaked out. So Salesforce stock CRM dropped over 20% on Thursday, and of course it did recover on Friday with a strong bullish candle. Now, whenever a stock drops significantly by 15-20% in one day, people start to panic and they often wonder, what should I do? Should I sell? Is it over for this stock, or should I hold? Should I buy more? What should I do? So it all depends on, did you enter this trade as a trader, or did you enter the stock as an investor? So there's a big difference. And of course, some of you may be looking from the sidelines and you're not in this stock yet. So the first thing is that if you are a trader, this should have never happened to you. Why? Because one of the things I teach all my trading students is never hold a trade through the earnings report. Because in an earnings report, anything can happen. The stock could gap up, it could gap down way below your stop loss. So always exit a trade the day before earnings are reported. But if you happen to hold it during the earnings, then the moment it drops, your stop loss is hit and you're out of the trade. So nothing to say, right? Okay. But if you entered this stock as an investment, like me, so I'm holding Salesforce as an investment, holding the other software stocks as well. I own Adobe, I own Veeva, I own ServiceNow. And yeah, so my stocks dropped a lot on Thursday because when Salesforce went down, the other software stocks went down in sympathy. So ServiceNow went down as well, Adobe went down as well, Microsoft, which I own, went down as well, and Veeva Systems also went down as well. So what should you do if you're an investor like me? Should you panic? Oh my God, why is this happening? I'm gonna get out. Of course not, right? So the important thing to ask yourself this question is this. When a stock drops, why did it drop? So in this case, it dropped because of the earnings report, not as great as expected, okay? Does that change the quality of the business you invested in? So as an investor, I invest in a business because I believe it's a high quality business. It's the top 1% of businesses in the world. It passes all my fundamental criteria. So with one bad earnings report, does it change the fundamentals, the quality of the business? That's what you got to ask yourself. Because remember that no matter how great a business is, it will go through good quarters and bad quarters. It will go through good years and it will go through bad years. It can't go through a good quarter all the time, a good year all the time. It will go through all these things, right? But over time, if it's a high quality company that meets all the right investment criteria, it will continue to grow and increase in value in the future. Any short-term drop in the stock price because of short-term reasons, to me, it's always an opportunity to buy, especially if you do not yet have a full position and you want to use it as an opportunity to build your full position. So the first question to ask is Salesforce a great business? Are the other software companies a great business? Like again, ServiceNow and Veeva Systems and Adobe, right? So that's a question you could ask yourself. So for me personally, I think they are great businesses. If not, I wouldn't have bought them, right? So why do I think they are great businesses? Well, because they have got consistently growing sales revenue, net profit, and free cash flow. Now, Salesforce, the net profit has been a bit choppy recently. That's because of their mergers and acquisitions that cause short-term increase in their M&A cost and their amortization cost, right? So, but if you look at the free cash flow, it's all been increasing consistently. If you look at Salesforce, for example, over here, you can see again, right? Revenue growing very consistently, right? EBITDA, which doesn't take into account the depreciation, amortization from their mergers, acquisitions, in yellow growing very consistently. their free cash flow, which is the most important thing I look at, all right, in blue, you can see growing consistently. Same thing with ServiceNow, right? Revenue growing consistently, free cash flow in blue growing consistently. Same thing with Adobe, right? Adobe revenue growing consistently, net profit, free cash flow. And again, this is not something that is common. If you look at all the businesses in the market, less than 5% of businesses pass this first criteria, having consistent growth in revenue and free cash flow. So by just applying that first criteria, it would eliminate 95% of all the stocks in the market, right? That's how you know it's a high quality business. Veeva Systems, same thing. Look at Veeva. Revenue growing consistently over time, even in a recession, even in a pandemic. Net profit, growing consistently over time. And look at free cash flow growing consistently as well. And if you look at other metrics like their gross profit margins, one of the highest in the industry, 70% gross margins, net profit margins 22%, return on capital over 20%, return on equity 12 to 15%. So these are very high quality businesses. And again, it shows in the stock price. And so you can see that in the long run, if you compare it with the S&P 500, that consists of all kinds of companies with some with lower profit margins, inconsistent revenue growth, low return on capital, you can see that these software stocks especially, they way outperform the S&P 500 over the long run. Like Microsoft, ServiceNow, Adobe, Veeva Systems, and Salesforce way outperforming the S&P 500. But again, in the short term, anything can happen, right? In the short term, a specific sector, a specific industry can sell off, can be out of favor. Remember that sectors and industries, they take turns being loved by the market when the prices go up and being hated by the market when prices go down. So this is a time when this industry, the software industry, is hated by Mr. Market. It is out of rotation. And it is these times when great companies sell at attractive discounts. And if you take a long-term view on these companies, if you ask me, is it an opportunity to add shares? I think so, if you do not yet have a full allocation. I've shown this slide before, I'll show it again. Every time when a stock drops, there's always a reason why it drops. You can have non-company specific reasons, like macroeconomic geopolitical reasons that have nothing to do with the company, but the stock drops simply because, say, the Fed raises interest rates, or the stock drops because of higher inflation, whatever it is, right? A macro reason. And then you've got company-specific reasons, like this reason, when a company misses earnings estimates or lowers forward guidance. Is this common? Of course, happens all the time. Even great companies go through bad earnings reports. And so these are the 10 reasons why a stock's price can drop. And out of these 10 reasons, as I've explained before, the only reason that should be the one to sell a stock as an investor is reason number 10. I will only sell a stock if the price dropped because of a structural long-term problem that has caused the company's economic mode to deteriorate. So it's losing its competitive advantage. It's losing market share to competition. All right. It is losing its pricing power. There's a permanent disruption to their business model. There's a permanent change in consumer behavior where they are no longer liking that product or their service. Sure, for this reason, you sell the stock as an investment. But all other reasons, if a stock drops because a major shareholder sold it, all right, or there's temporary bad news like a product recall or lawsuit or sex scandal, or there's a cyclical slowdown for the demand for their products and services, which is in the case of the software companies, right? Or the company, again, misses earnings estimates. These are not reasons to sell an investment. These are reasons to buy an investment, as long as the price drops to an attractive level. So the great thing about the stock market is that the market always overreacts. It always overreacts to good news and overreacts to bad news. And whenever it overreacts to bad news, that's when, again, great companies get cheap temporarily. And that's how you can get really rich if you take advantage of these short-term mispricing. So Was the drop in Salesforce an overreaction by the market? Did they freak out for no reason? Well, let's take a look. So again, the stock price dropped 20% because of the earnings report. But what was in the earnings report? So let's take a close look at this. So they reported their Q1 2025 results, and so they reported revenue of 9.13 billion, which is an increase of 11% year on year, and it was lower than what was expected. So analysts expected 9.17 billion. So basically they missed their revenue report by 1%. Okay? Earnings per share came in at $2.44, this adjusted earnings per share, and earnings per share is up 690% year on year versus 2.38, which was expected by analysts. So they beat earnings by 2%. Free cash flow, which is the thing that to me is the most important thing, free cash flow, came in at 6.08 billion. So free cash flow increased 43% year on year. So as an investor, I don't look at myself as really a stock predictor, right? I see myself as an investor of the business. So I ask myself, as a shareholder of this business, am I happy that the business that I invested in grew revenues at 11% and grew their free cash flow at 43% and grew their earnings per share at 600%? Hell yeah, I'm pretty happy, all right? So as an investor, don't judge your investments by the short-term price movement, because short-term price movement is oftentimes driven by emotions, by speculation, and by a lot of manipulation. Judge your investments by the performance of the underlying business, because over time, when the business does well, the stock price will do very well. But in the short term, the stock price can sometimes go a bit crazy and not reflect the true value of the business. You have a lot of mispricing, right? Now, then Salesforce, they gave their forward guidance for the next quarter and for the entire year. So was it really that bad? Let's take a look. So their forward guidance for the next quarter was this. They are forecasting adjusted earnings per share in this current quarter, quarter two, at $2.34 to $2.36 on a 9.2 billion to 9.25 billion revenue, right? So that's a 7 to 8% year-on-year increase. So analysts expected 2.4 or $2.40 in adjusted earnings per share on a 9.35 billion revenue. So in other words, they have so-called disappointed their forward guidance in Q2 by 1.3%. How about the forward guidance for 2025? So Salesforce is forecasting that for the entire year, their revenue will be 37.7 billion to 38 billion, within that range. So that represents an 8 to 9% year-on-year increase, and that's below the revenue estimate of 38 billion. So again, it's a 0.92% miss, not even a 1% miss. However, adjusted earnings per share for the full year is expected to be $9.86 to $9.94, which is above the $9.80 per share estimate. So in other words, what caused a 20% drop in Salesforce? The fact that their current revenue missed by 1%. Although they beat by earnings and cash flow is up by 43%, and their forecast for the full year, revenue missing by 0.92%. That's it, right? So as an investor in this business, is this result freaking me out? No, I'm pretty happy with it, right? And if the share price wants to drop 20%, by all means, drop 20%. I would just buy more of the shares, right? Take advantage of it, right? So that's Salesforce. Now, the best part is that because Salesforce stock went down, all the other software stocks went down in sympathy, even though some of these other stocks didn't report any results. In fact, ServiceNow, which is another great business, reported fantastic results a couple of weeks ago, and the share price went up. And if you miss buying that stock, the good news is that the price now has come back down to a level where, as an investor, you can take advantage of it again, because the price dropped over 10% because of a reason that has got nothing to do with the company itself, simply because it's in the same industry and Salesforce, right? So I love to buy a stock when it drops in sympathy with other stocks. It's like how I bought a lot more of this Elevance Healthcare a couple of months ago. It dropped because of United Health dropping. And of course, I bought more United Health, I bought more Elevance Health, and now it's way above those purchase prices as well. And then of course, Adobe reported great results, didn't report results, but share price went down because of Salesforce, and then Microsoft went down as well. Okay, Microsoft went down as well, but not that much. But at least it went down to a level where it becomes more attractive. And what else went down? Let me see. Veeva Systems went down. So Veeva Systems is another high quality software stock that dropped over 12% because they reported earnings results, which again, people freaked out about. But again, was it that bad? Was it an overreaction? Let's take a quick look at Veeva Systems. So for Veeva, they reported revenues of $650.3 million, an increase of 24% year on year. Very bad? I don't think so. Pretty good to me, all right? And this was compared to the expected revenue of $642 million. So they beat revenue by 1.3%. Their adjusted earnings per share came in at $1.50, up 82% year on year, versus $1.42 expected earnings per share. So they beat earnings by 5.3%. Adjusted net income came in at $247 million, up 67% year on year. Free cash flow, which is my favorite measure, came in at $755 million, up 50.1% year on year. So in other words, Veeva System beat on revenue. They beat on earnings. Their free cash flow increased 50%, and the stock dropped 12%. Why? Because in the short term, the market can be nuts. So as an investor, should you be concerned or excited? To me, I get excited because opportunity, right? Now, of course, if you already have a full position, now I already happen to have a full position in Veeva, so I'm not buying more. Because once I've got a full position, I just let it ride, right? Just let it ride and let it go up later on, right? But I do sell some cash secured puts at time to collect some extra premium. The only thing that freaked people out about Veeva was, again, their revenue guidance. So they are saying that, okay, for next quarter, we expect our revenue to be up to $667.5 million. And this was below the analyst estimate of $675.3 million. So they miss by 1.2% their future guidance. Now, one thing you have to understand about many of these companies is they like to do lowballing. So it's kind of like they tell you they won't do so well so they can beat it easily. It's kind of like your son telling you that, Dad or Mom, I think my next exam, I'm not going to do too well, right? They always do a lowball. So the moment they get results better than that, you get very happy, you give them a present, right? So companies do that all the time. So I'm not too concerned about all this forward guidance being lower than expected, especially if it's just a miss of freaking 1%, okay? And the company dropped their revenue guidance for the full year from $2.73 billion to $2.71 billion. But it's still a 13.5% year-on-year increase. So again, it's just a 1% lowered forward guidance. What did the market do? Drop 12%, okay? So as an investor, if you're investing in it, is it an overreaction? Well, I think so. So if you are having all these software stocks in your portfolio and your portfolio has dropped significantly in the last few days, it's okay, don't worry. The same thing happened to my portfolio, right? So as long as you're holding good quality companies, don't be concerned about the short-term volatility. It will go up and down in the short term, but rest assured, in the long run, if you hold great companies, you will keep outperforming the market, right? So just to show you, for example, year to date, I am actually underperforming the market because of the software stocks dragging down my portfolio, because I've got a lot of these software stocks. And let me just log into my account. Okay, so for the month of May, right? The month of May, which just ended, my portfolio is up only 2.32%. It was actually up a lot higher than that, but again, it got dragged down by all my software stocks, which again, I'm cool about it because again, it's a short-term sell-off. It should rebound back pretty strongly by the end of the year, right? But the good thing is that year to date, I'm up about 8.46%, underperforming the S&P 500, which is up 11% again because of the software stocks. But on a one-year basis, I'm still above the S&P 500. I'm up 27% over the last 12 months versus the S&P 500 up 25%, right? So again, remember, as an investor, following all the rules of investing in great companies, you don't worry in the short term if you underperform the S&P, in the short term your portfolio drops. Stay the course. Stay invested in good companies and rest assured that over time, in 1 year, 3 years, 5 years, you're going to way outperform the market like I have been doing, like my students have been doing. Hope this has been useful and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.